The consumer is a big part of U.S. GDP growth, and the cutback in spending probably reflects something else we've been writing about at High Frequency Economics, which is that a lot of people built up a lot of cash savings over the pandemic period, and that we saw that in bank balances, money on deposit at banks. We've seen that in savings rates. A lot of people from working at home saved money. A lot of people were overcompensated being on unemployment, and those savings are winding down now. That cushion is winding down, and if anything, people are now looking at the prospect of having to restore their cash balances, and that means they're going to be spending less. So a slowdown in consumer spending, not a crash, not a recession, but a slowdown in consumer spending is very much a part of what we've been thinking about.
So, I guess what I need to ask is have the interest rates had the bang for the buck that the market and the Fed thought they would do as well? Because we're now pontificating over November, September, a shoo-in for no change as well. It would be an extraordinary surprise if there was a hike there as well. But bearing in mind, you've got the likes of Goldman Sachs upping their growth forecast for the US economy, I think to 2% rather than the previous 1.1 as well. So the economy is still moving quite nicely. The consumer, by and large, doesn't look in too much trouble, although it is a bit more stretched, as that survey just said there as well. And inflation is still way too high, albeit coming down at a headline and a core level as well. Have the interest rates worked?
Interest rates have had less of a bang than we would have expected from a 500 basis point tightening of monetary conditions. In previous business cycle experience, we would have expected to see a much sharper slowdown of the U.S. economy. That hasn't happened, largely because people have had a lot of cash put in their pockets by government programs, by the printing of money, and so forth. So we're working that off. We're getting back to the point where monetary policy can bite again, and there will come a time when it will be even more important. We saw in the NAHB figures yesterday, we saw the weakness ascribed to, in the housing market ascribed to the higher financing costs for houses. So we're getting to the point where monetary policy will bite more. But again, consumers still have a lot of cash. They still have a lot of wealth if they're homeowners. So not everybody in the United States is doing well, as we see with the auto workers in Detroit. They're not happy. But for many people in the United States right now, they're better off than they had been before.
Carl, there is a perception that if you tackle the lower end, if you tighten spending, then the economy slows down because it's those with less disposable income, lower demographics that typically spend the money that they have, hence the problem with those checks that were dispensed. But we know that there's been greater disparity in the United States in recent years as well. I mean, this under even the Trump-era presidency. What's the challenge this time round then as we talk about slower spending? Because I don't know if the top end is slowing their spending as much. I mean, there is a view they never spent, but I don't know. From what I've seen in recent times, and we see it on the luxury spending numbers, the US has been a big component of those luxury spending numbers as well. Is the top end of town going to tighten their belt at some point?
Well, the top end right now is still doing rather well. I mean, financial assets are still doing quite well. Housing assets are doing quite well. Top end is not feeling a lot of pain at this particular point in time. And things like a rise in gasoline prices, that doesn't really affect them very much at all, given where they are on the income scale. But the lower end, which is the bigger part of the population, they're starting to feel the pinch. They've been feeling a pinch on real wages all along through this episode because real wages have not kept up with inflation. So we're going to see increased labor unrest. We're going to see increased demand for wages, and we're going to see spending cutbacks and survey results like the ones that you and Steve were talking about just a few minutes ago.